In the beginning of the year, I talked about two stocks that could potentially double in 2024. One of them was Hims and Hers, which is the orange line right here. And at one point, it was up about 150% year to date, but has now gone down to just 72% return so far this year. And the other stock that I mentioned was C Limited, ticker symbol SE, which is the purple line right here. And as you can see, the stock has doubled since the start of the year, now up 114% year to date, mainly because of strong Q2 earnings. I've already talked about Hims and Hers in my previous video, so today I want to talk about C Limited stock. We'll talk about the company's Q2 earnings, why the stock has performed so well, and what I will be doing with the stock moving forward. And then later on in this video, I will also share one more Asian stock that hasn't done so well, but I think will do very well in the next 12 months or so. So do stick around if you want to know more about this stock. But with that being said, let's talk about C Limited stock first. So C Limited is a Singaporean-based tech conglomerate that operates the leading e-commerce marketplace in Southeast Asia known as Shopee. It also owns Garena, which is a gaming company that owns some of the most popular mobile games in the world, including Free Fire, as well as C-Money, which is its fintech business. So, taking a look at Q2 results, revenue for the quarter was $3.8 billion, dollars, up 23% year over year, which beat analyst estimates by $90 million, dollars, which is very good. And as you can see, after several quarters of just mid single digit growth in 2023, the company has reported back to back 20% plus growth in the last two quarters. So growth is accelerating and revenue is at record highs, which speaks volumes about C Limited's competitive moats and management's strong execution. And I think these are reasons why investors are starting to like the stock once again. So breaking it down by segment, we have revenue by segment, and we can see that Garena, which is the gaming division, its revenue is still declining, which is a concern for most investors. However, keep in mind that the decline in revenue was due to lower recognition of accumulated deferred revenue due to lower bookings in previous quarters. With that in mind, Garena bookings are actually up 21% year over year to $537 million dollars, and as you can see, bookings growth has been accelerating over the last few quarters, which should mean that Garena revenue growth should turn positive very soon. And besides, Garena saw strong sequential growth in quarterly active users from 594 million in Q1 to 648 million in Q2, which is more than 50 million net new users in a single quarter. And this is due to Free Fire, which saw more than 100 million daily active players every single day throughout Q2. So that's very strong momentum in the gaming business, and I believe it is just getting started. So now moving on to Shopee, which is the e-commerce business. The company generated $2.8 billion, dollars, which is the bulk of the company's total revenue. The company generated $2.8 billion dollars in Q2, up 34% year over year. And as you can see, growth has been accelerating over the past few quarters, which is impressive considering Shopee's already large scale. So this was driven by GMV of $23.3 billion, dollars, up 29% year over year, and gross orders of $2.5 billion, up 40% year over year. So Shopee revenue growth was also driven by increased take rates, which is defined as revenue divided by GMV, or put simply, how much Shopee makes for each dollar transacted in the platform. And as you can see, Shopee's take rate is at 12.1% in Q2, which is an all time high for the company, which is really good. So I think higher take rates is very bullish for C Limited because it shows high pricing power, and it also means that Shopee is monetizing its user base more effectively without having to sacrifice GMV growth. And also, management still sees good opportunity to improve take rates, especially in the advertising department, where Shopee's ad take rate remains lower than the industry average in more mature e-commerce markets like the United States. So as take rates continue to improve, it should result in higher incremental revenue growth at lower incremental costs. So that would result in improved profitability over time. And last but not least, we have C Money, which is the fintech business. So the company generated $519 million in revenue in Q2, up 21% year over year, mainly due to its credit business, which saw loans of $3.5 billion, up 40% year over year and 8% quarter over quarter. The company also ended the quarter with 21 million active users, up 58% year over year and 14% quarter over quarter. So, growth in the fintech business is very strong, and I think C Money has a lot of opportunities to monetize its rapidly growing user base over time, which should lead to robust revenue growth in the future. Looking at adjusted EBITDA by segment, we can see that Garena adjusted EBITDA was $303 million in Q2, which represents an adjusted EBITDA margin of 70%, which is the highest it has ever been in 3 years. On the other hand, Shopee adjusted EBITDA is negative $9 million in Q2, which is close to break even and is on track to turn positive in Q3 and beyond, as management has pointed out in the earnings report. And finally, C Money has an adjusted EBITDA of $165 million in Q2 at a 32% margin, which is nice and robust. So, all in all, we can see that adjusted EBITDA improved sequentially across all three business units, reflecting ongoing operating leverage. So, this led to adjusted EBITDA of $448 million in Q2 at a 12% margin, which has been improving over the last few quarters, as you can see right here. And with all three businesses scaling further and improving profitability further, I think it's reasonable to assume that adjusted EBITDA will trend higher from here. And over time, net income should improve as well. As of Q2, net income was $80 million at a 2% margin, which turned positive after three consecutive quarters of negative net income margin. And although GAAP EPS of 14 cents missed by 5 cents, we can see that net income has been improving, and I think it will continue to improve as the company scales further. And besides, Grab is already cash flow positive with an operating cash flow of $618 million in Q2, representing an OCF margin of 16%, which is very healthy and has been positive for 7 consecutive quarters. So that's very good to see. So, on a high level, C Limited's Q2 results were nothing short of spectacular. Growth across all three businesses are accelerating, profitability across all three businesses are improving, Garena is rebounding, Shopee is taking market share, and management also expects Shopee to turn profitable in Q3 and even raise their 2024 GMV growth guidance to mid 20%. In addition, C Money continues to grow rapidly. So, based on all these results, it's no surprise that C stock rallied following its Q2 earnings. But even despite the recent rally, I think C stock is still severely undervalued. As you can see, C stock trades at an EV to revenue multiple of just 2.9 times, which is much lower than its pre pandemic level of about 10 times and certainly well below its peak multiple of about 31.8 times. I also did a DCF model on C stock, so you can pause the video to see my assumptions here. But to keep it short, I expect 2033 revenue of just $40 billion, which is a CAGR of just 12%, a long-term free cash flow margin of 18.5%. For context, C Limited has a free cash flow margin of 15% in Q2, so I think my assumptions are very, very conservative. And based on a perpetual growth rate of 2.5% and a discount rate of 10%, I arrive at a price target, a base case price target of $129 a share for C stock, which is an upside potential of 57% based on the current price of $82 a share today. So as you can see, I think C Limited stock is still severely undervalued despite up more than 100% year to date, which is why I will continue to hold C Limited stock. I won't be adding here, but I will be interested to add if we see a major pullback. And by the way, if you're interested, you can read my in-depth article on C Limited at Seeking Alpha, where I cover the company's Q2 results in much more detail. So if you're interested, you can find the link to that article in the description box below. So that's what I think about C Limited stock. And now let's talk about another Asian stock, which I think is a great buy at current levels. And that stock is none other than Grab Holdings. So in a nutshell, Grab is the leading super app in Southeast Asia, offering various services under a single app, including ride hailing, food delivery, digital payments, and so on. But unlike C Limited, Grab stock hasn't done particularly well, trading pretty much flat for the year. And just recently, the company reported Q2 earnings that fell short of expectations, sending shares lower by more than 7%. So Q2 revenue was $664 million, dollars, up 17% year over year, but this missed analyst estimates by $12 million. Dollars. More importantly, this was a deceleration from Q1's growth of 24%, so I think the growth slowdown might have scared some investors. So if we break it down by segment, we can see that Grab's more mature segments, namely the deliveries and mobility segments, saw a material slowdown in Q2, growing only 11% year over year and 19% year over year respectively, as compared to 19% growth and 27% growth in the previous quarter. But on the bright side, the financial services segment continued its robust growth, growing 54% year over year to $60 million in Q2. But that being said, I think investors didn't like the growth slowdown in both the deliveries and mobility segment. And to make matters worse, profit margins as a percentage of GMV for these two segments have also gone down, which was 1.5% for the delivery segment and 8.2% for the mobility segment, which is down quarter over quarter, as you can see right here. And also, the financial services segment is also still unprofitable at a negative 40% adjusted EBITDA margin as a percentage of revenue. So, altogether, total segment adjusted EBITDA was $148 million in Q2, representing a margin of 3.3% as a percentage of GMV, which is down 30 basis points quarter over quarter. But while the decline in margins quarter over quarter was a concern, keep in mind that this was due to the company ramping up incentive spending to promote and support the launch of new features such as Saver and advanced booking in the mobility space, not because of competition. So I think the decline in margins is justified and I see no problems whatsoever. Whatever it is, investors didn't like the fact that growth slowed down, that incentives rose, and that margins fell, as you can see right here. But there's also one more reason for Grab's underperformance, and that is foreign exchange headwinds as Southeast Asian currencies weakened against the US dollar. So FX headwinds were so severe that it negatively impacted GMV growth by 528 basis points and revenue growth by 549 basis points, which is a lot. So without these currency exchange pressures, Grab would have easily beaten estimates. So just for comparison's sake, I've also compiled some of Grab's growth metrics on a reported basis and on a constant currency basis. And as you can see, growth on a constant currency basis for each of Grab's metrics look very solid. For instance, on-demand GMV grew by 18% as opposed to 13% on a reported basis, and revenue grew by 23% on a constant currency basis versus 17% on a reported basis. So despite the slowdown in Grab's reported numbers, its underlying business remains strong and growth remains robust on a constant currency basis. And furthermore, management expects revenue growth to accelerate beyond 2024, which speaks volumes about Grab's potential and management's confidence in the business. It's just unfortunate that FX headwinds are misleading a lot of investors. With that being said, I would rather focus on metrics that are not affected by foreign currency exchange rates. For example, we can look at monthly transacting users, which is MTU, and as of Q2, Grab has 40.9 million active users, which is up 17% year over year to a new all time high, which is very impressive. And also, the company added 2.4 million net new customers in Q2 quarter over quarter, which is the highest it has ever been, I think, since 2021, right here. So, this is really good because MTU is a leading indicator for future revenue and profitability growth. Adjusted EBITDA is also at record highs at $64 million in Q2, which represents a 1.4% margin as a percentage of GMV. And yes, the company is still unprofitable on a GAAP basis with a net loss of 68 million in Q2, representing a net income margin of negative 10%. However, the company is already cash flow positive with an adjusted free cash flow of $36 million in Q2. In addition to that, management now expects 2024 adjusted free cash flow to turn positive for the full year, which means that adjusted free cash flow is expected to improve in the second half of the year, considering that Grab has adjusted free cash flow of negative $63 million in the first half of the year. And this also means that the company is inching closer to GAAP net income profitability, which I think will be a huge catalyst for the stock. That said, Grab has a net cash liquidity position of $5.3 billion, which is a lot of money, so I don't think Grab will go bankrupt anytime soon. And to give you a little bit more perspective, $5.3 billion of net cash is more than 40% of its current market cap of about $13 billion, which also shows how undervalued the company is right now. Speaking of which, Grab is still trading at the bottom range of its historical multiple at just 3.2 times its revenue, so Grab has never been cheaper from a valuation perspective. And as for me, I have a base case price target of about $4.82 for Grab stock, which represents an upside potential of about 45% based on the current price of $3.33. Again, you can pause the video to look at my key assumptions right here, or you can read my recent Grab article, which goes into much more detail. So if you're interested, you can find the link to that article in the description box below. But long story short, I like Grab stock and I think it's severely undervalued at just $3.33. There were no red flags in its Q2 results, just that FX headwinds make it look like Grab is struggling as a business, which is not true. So I think Grab's investment thesis remains intact, its competitive moats remains durable, and its long-term potential remains massive. And I think Grab stock is a really, really good buy at current levels, especially after the recent sell-off due to the Q2 earnings miss. With that being said, I want to hear from you. Do you have Grab stock or C Limited stock in your portfolio? What do you think about their Q2 results? Please let me know in the comment section down below. If you enjoyed this video, please hit like and subscribe for more videos like this. As always, thank you guys for watching this video. I appreciate you and I hope you have an amazing day. See you guys on the next one.